everyone, up here we are describing about the adjusting accounting. Number 1. Timing period assumption. A. Fiscal and calendar years. Both small and large companies prepare financial statements periodically in order to assess their financial condition and result of operation. Accounting time periods are generally a month, a quarter, or a year. B. Accrual versus cash basis accounting. What you will learn in this chapter is accrual basis accounting. Under the accrual basis, companies record transactions that then a company's financial statement in the periods in which the events occur. For example, using the accrual basis to determine net income means companies recognize revenues when earned. It also means recognizing expense when incurred. An alternative to the accrual basis is the cash basis. Under cash basis accounting, companies record revenue when they receive cash they record and expense when they pay out cash. Recognizing revenues and expense. It can be difficult to determine the amount of revenues and expenses to report in a given accounting period. Two principles help in this task: the revenue recognition and the expense recognition principle. Number 1. Revenue recognition principle. The revenue recognition principle requires the companies recognize revenue in the accounting period in which it is earned. In a service enterprise, revenue is considered to be earned at the time the service is performed. Number 2. Expense recognition principle. Accountants follow a simple rule in recognizing expenses. 2. Expense recognition principle. Accountants follow a simple rule in recognizing expense. Let the expenses follow the revenues. Thus, expense recognition is tied to revenue recognition. The basic of adjusting entries. Adjusting entries ensure that the revenue recognition and expense recognition principles are followed. Adjusting entries are necessary because the trial balance the force pulling together of the transaction that might not contain up-to-date and complete data. Type of adjusting entries. Adjusting entries are classified as either deferrals. 1. Prepaid expenses. Expenses paid in cash and recorded as assets before they are used or consumed. 2. Unearned revenues. Cash received and record liabilities before revenue is earned. Accruals. Number 1. Accrued revenues. Revenues earned but not yet received in cash or recorded. 2. Accrued expense. Expense incurred but not yet paid in cash or recorded. Adjusting entries for deferrals. The two types of deferrals are prepaid expenses and unearned revenues. A. Prepaid expenses. Companies record payments of expenses that will benefit more than one accounting period as assets, called prepaid expenses or prepayments. When expense or prepaid an asset account is increased to show the service or benefit that the company will receive in the future. Let's look in more detail at some specific type of prepaid expenses. Beginning with supplies. The purchase of supplies such as paper and envelopes result in an increase to an asset account during the accounting period the company uses supplies. 2. Issue grants. Companies purchase insurance to protect themselves from losses to fire, death, and unforeseen events. Insurance must be paid in advance, often for more than 1 year. The cost of insurance paid in advance is recorded as interest in the assets account prepared insurance. 3. Depreciation. A company typically owns a variety of assets that have long lives, such as buildings, equipment, and motor vehicles. The period of service is referred to as the useful life of the set of the
B. Unearned revenues. Companies record tax received before revenue is earned by increasing crediting a liability account called unearned revenues. 2. Adjusting entries for actual. The second category of adjusting entries is actuarial. A. Accrued revenues. Revenues earned but not yet recorded at the statement that are accrued revenue but. B. Accrued expenses. Expenses incurred but not yet paid or recorded at the statement that are called accrued expenses. Let's look in more detail at some specific types of accrued expenses, beginning with accrued interest. 1. Accrued interest. 2. Accrued salaries and wages. 3. The adjusted trial balance and financial statement. The purpose of an adjusted trial balance is to prove the equality of the total debit balance and the total credit balance in the ledger after all adjustment. A. Preparing the adjusted trial balance. In the book Illustration 3-25, you will see that 3 or more accounts in the adjusted trial balance as a result of the adjusting entries made at the end of the month. B. Preparing financial statement. Companies can prepare financial statement directly from the adjusted trial balance. Present the interrelationship of data in the adjusted trial balance and the financial statement. Companies prepare the income statement from the revenue and expense account.